It's Monday, December 7th. Welcome to Market Foolery. I'm Chris Hill. With me today from the Great White North, it's Jim Gillies. Good to see you, my friend.
Good to be seen, Chris. How are you?
Doing well. We're going to talk secondary offerings. We've got an initial public offering to discuss, but we're going to start today with Eastman Kodak. And I think for at least some of our dozens of listeners, it's worth pointing out that Eastman Kodak is the company that for decades was the go-to name in film. The actual film that you would put in a camera to take photographs. Back in July, shares of Kodak went from $2 to $20 in the blink of an eye because Kodak got a U.S. government loan of more than $750 million to help produce pharmaceutical ingredients. It has come back down from that, but shares of Kodak up more than 50% this morning because U.S. regulators were looking into the announcement, the timing of the announcement to see if there was anything improper, and looks like they got cleared from U.S. regulators, and so the stock is up.
Yeah, and Chris, you know what? It's actually even worse than you said, because there was a quick spike in early August or late July, I believe, up to as high. It closed at $33 from, as you said, $2. There was a transaction on that date that went through at $60. Good on the person who was selling it, the intraday high at $60. Good on the person who was selling it. Not so great for the person who bought it. But as you said, it did drift down back below $10 because there was a lot of controversy, a lot of talk about how the insiders were perhaps getting, windfalls because they'd just given themselves grants beforehand, equity grants, and now the stock is up from stock prices up. That's a bit of a red herring, in my opinion, because in a lot of cases the equity grants take years to vest, so the stock price spiking today does them no favors, at least until they can put their thumb on the scale and move it. But there was no indication there. As you said, they've been kind of cleared today. There was a similar review in September where a law firm with the best name ever, I think, it's Aiken Gump, as in Forrest Gump. They cleared executives of wrongdoing. The stock was about $12, but the stock has been flying around up and down, and it's all indicative of what I'll call speculative frenzy. There's no real there here. There's some we can talk about. Look, as you mentioned, the Kodak was film. Well, when you go down what is film development and what have you, Kodak is essentially a chemicals company, really. Right. I mean, that's, which is important when you were dealing with film. And so, of course, we've all moved to digital, and we take 78 pictures of our dinner every night now on our iPhones. And so film's kind of been left behind. And so, they went through bankruptcy. They filed for bankruptcy in 2012. They exited the legacy business, sold off a bunch of patents. Came out in 2013. So I'm kind of stepping back here and saying, what is the actual business of Kodak today? And the actual business of Kodak, absent this government loan, absent the insiders who may or may not have put their thumb on the scale when, granting themselves equity cookies, the actual business is one that just burns money. Since coming out of bankruptcy, they burned about $630 million, I'd say, in free cash flow, but that's the opposite of free cash flow. It's just been a company that's been just in steady erosion, and this isn't new money. The company's not producing cash. This isn't new cash that's producing. This is a loan. It was a loan. Yeah, they get a sweetheart rate from the government, but at the end of the day, you got to pay it back, in theory. And so really, look, I would like to see Kodak succeed with this developing chemicals for fighting COVID, although in a world with multiple vaccines and rapid rollout of vaccines, I wonder how much that's going to matter ultimately. But if they get there's the equity here. I look at Kodak and say there's too much speculation for me right now. But if the actual business can transition to producing chemicals for pharmaceutical use, and they start producing cash, this might be kind of interesting. But right now, it's just people playing speculation games. So.
Because the last time you were on the show, just a week ago, we were talking about BlackBerry, which at one point in time was the dominant mobile phone company in North America, and appears to be, after several very rough years, appears to be successfully turning itself into a viable cybersecurity company. So to your point, because that's what I was going to ask you, like, can't Kodak, isn't there a universe in which Kodak successfully pulls off the transition from, we were once the dominant name in photography film, that industry has gone away largely, and so therefore we're going to become a successful chemicals company? It sounds like the answer to that is yes, but they haven't demonstrated it yet.
Correct. Yeah. If you were betting, and full disclosure, I am betting on the transformation and turnaround of BlackBerry. If you were betting, you have had a lot of time to get in. Okay. Okay.
You don't need to time this one.
Right. Yeah. No. So if Kodak is successful in their transition, and again, I kind of think the announcement of the loan, they've now been vetted and cleared by two different bodies, independent bodies. Management, like I said, they have equity cookies that don't vest yesterday. They've got to work for. I would like to see them pull it off, and if they do pull it off, probably even from here at $11, $12 a share today, you'll probably do okay. But you've got time to watch. You don't have to get in today or probably this year. And if the BlackBerry model is indeed a model, you probably got a few years to worry about this one. So interesting to watch.
Speaking of things to watch, Airbnb is going public on Thursday. They had set the price range for the stock when they started doing their roadshow at $44 to $50 a share. News out this morning that Airbnb, presumably because of an overwhelming amount of interest they've gotten to this point, they've increased their price range on the stock. It's now $56 to $60 a share. There's absolutely the possibility on Wednesday we get news that it gets ticked up even higher. Put aside for the moment what's going to happen on Thursday. The business of Airbnb, is that one that is of interest to you?
It's of interest to me. It's probably not one I'm interested in owning for a while, but to be honest, I generally avoid IPOs anyway. I have a deathly allergy to going after what's popular. Usually if something's hot, you see me running in the opposite direction. So, and that's something I struggle with every day. But I believe the IPO, I don't have the article up in front of me, but I believe the IPO selling between $56 and $60 values the entire company somewhere north of $42 billion.
That is correct.
Okay. And they're only offering about $3 billion worth of stock. So the insiders are holding on to the rest of it, I'm sure, to dribble it out later or otherwise realize value. And that's fine. But there is going to be a lot of demand for this. So you say you want to avoid what happens on Thursday. I'm going to tell you what's happening on Thursday. It will close higher than 60. I'd be willing to bet a lot of money on that particular prognostication. But the business itself, I think, is interesting because if you look through the S1, and I took an opportunity to glance through the S1 this morning. That's the filing document with all the prospectus and numbers, and they shine up the company so investors can look at it and see what's what. This was a nicely growing business, cash generative, which for a lot of these businesses in this time that we're in a time, I think it's fair to say that the markets are enthused about pretty much everything we throw in front of them right now, regardless of quality. So Airbnb is a higher quality name, in my opinion. They were nicely cash generative heading into 2020. Year to date, 2020 is a little bit of a different story for obvious reasons. But if you believe that the pandemic is finite and you believe that the pandemic has an end that is coming sooner rather than later, I think it's fair to say people are molten to travel again. And I think you can make an argument. I certainly will make an argument that doing an Airbnb is actually in some cases can be quite preferable to traditional holidays. Or of course you don't want to stay we're going to Calgary the week after Christmas. We're going skiing like we always do, and we usually stay with friends. We're not doing that. We are renting an entire house through Airbnb, where we can basically self-isolate on our own and then just go skiing on the ski hills. So naturally, social distance sport. So I think that I think the business here is interesting, and there are signs it's pulling out. But the fact that the investment bankers are saying, "Hey, you could bump your price." Well, I mean, look, I'm pretty agnostic about that because that's the banker's job, and their job is to get the most money for these shares, the most possible. So good for them. I'll hold up Beyond Meat as an example where I think the IPO there priced at $25, and within a month it was $200. And boy, if I was Beyond Meat, I would be a little irritated with my investment bankers there because you guys left money on the table. So I'm interested to see what happens here. I like the service, personal use. I imagine it will be expensive, but I don't think that's a surprise in the present market. I think it's one that I'll be very interested in watching going forward.
Yeah, and it's just sort of I don't begrudge anyone for this, but it's the nature of the media that you're seeing a lot of stories of Airbnb and DoorDash both being name checked because before the end of this calendar year, those are the two biggest name companies that are going to go public. So I understand why that happens. I just think from an underlying business standpoint, one of them is much more attractive to me personally than the other, and it's Airbnb.
Yeah, I was going to say, and it's not DoorDash.
And it's not DoorDash. Our email address is marketfoolery@fool.com. Question from Scott in San Diego. He writes, I joined Motley Fool Stock Advisor back in March and have been loving my picks based on the information shared by your team at the Motley Fool. Thank you, Scott. We aim to please. He writes, a few months ago, I bought shares of Twist Bioscience, and the stock has doubled since then. Last week, they announced a secondary offering. Twist Bioscience is not yet profitable. Are offerings at this point of the business cycle common to fund their growth, or can it be seen as a sign of distress? It's a great question, Jim. And Scott sort of gets at the one-word question that always pops into my head whenever I see the headline, Company X announces secondary offering. And the question is, why? Because there are really good reasons to do a secondary offering. And there are, to his point, there are also times when the reason is distress.
Yes, and in this case, I was going to say the answer to his question, or both versions of his question, is yes. There are reasons happy reasons to do secondaries, and there are unhappy reasons to do secondaries. The unhappy reasons generally being, we will die without your money. And those types of companies, you probably want to stay away from those. Now, I don't know anything about Twist Bioscience. I'm not a biotech guy. The guy we should have to talk about the actual business is Brian O'Reilly, who was on before us. My eyes glaze over at the tech here. Now, they claim to be on the front lines of fighting COVID, and good for them. And that's, we wish them every success. But this is a very typical bioscience company, as in it's cash burner. There's no cash happening here. This is the latest in a series of secondary offerings, and I will predict it probably won't be the last. They IPO'd about 2 years ago. They raised about $160 million, I think, in their IPO. They did another secondary, or they did a first secondary about a year ago. Brought in another $300+ million. They've now just upsized this one to $300+ million. And I will suggest to you that this is exactly what you want to see them doing. You have an expensive stock. You have no means of self-financing yourself. You want to see this company using their stock as currency to raise capital when times are good, and at almost all-time high stock price. I would suggest times are pretty good. And so what this is doing is that the company looks like it's burned about $150 million last year, has about $300 million on the balance sheet. Now, it's likely that was an elevated cash burn level, but you've probably got 2 or 3 years of cash left on the balance sheet at the present burn rate to build their business and to develop their products. You're about to double that, and as your cash burn does come down, I think this is probably the market saying, this is a great move. The company now has, instead of maybe 2 or 3 years of runway, maybe it's got somewhere 5 to 10 years of runway. As I said, it's an expensive stock. use your expensive stock as currency. And that, Scott, is, I think, why the market has reacted so well to this offering.
Jim Gillies, always good talking to you. Thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.